I've been including one trade from my previous week in my market outlooks, and looks like all the members are appreciating this new format, so I will continue doing that. In this week's market outlook, I will start it with a trade alert on CI, which is Cigna. And this was an interesting trade because it doesn't follow the typical mean reversion setup that I usually use. If you remember, I take different kinds of trades in my group. So my main bread and butter trade is the mean reversion setup that is described in my book. But I do take other kinds of trades, so post earning trades, support and resistance trades, TTM squeeze trades. And this particular trade is actually based on TTM squeeze. So I'll be going through this trade and show you what kind of setup does a TTM squeeze provide you. So if you look at the trade alert, it was sent out on 7/3, and I will switch to a chart shortly. But if you look at the trade alert here, it's a bear put spread. Symbol is CI, which is Cigna. The trade structure is 325 320 put spread. So I'm buying the 325 put, selling the 320 put at the same time to create this trade structure. Now, sector is healthcare, expiration is 7/19. Trade type, that's where I mentioned the kind of trade that I'm taking. In this case, it's TTM squeeze. So, and cost is 250 because it's a $5 wide spread, and potential profit is also 250. As you know that all my trades, uh, when they are successful, they have the potential of doubling their money. Of course, I do close my trades at 94% profit target. I don't wait for 100% because to avoid assignment and exercise on options. So now the if you look at the notes on this trade, so number three, reasons to take the trade. I'll always remind you that whenever I take a trade, there is nothing special about me taking a trade. Just because I took a trade doesn't mean that it's going to be successful. So at that point of time when I'm taking a trade, it makes sense to me, so I will take the trade. But there could always be, the stock market is a two-sided market. So just because I'm lacking the trade, somebody else is actually taking the opposite position, which is what makes the entire, that's how you get a fill on your trade. So I'll give you conflicting reasons so that you can analyze the trade that I have just taken and decide based on your risk tolerance, your own technical analysis, whether that trade is suitable or not. So coming back to number three, which is reasons to take the trade, I've mentioned that healthcare sector is looking horrible. Take a look at XLV. XLV is the ETF that follows healthcare. Although this is a setup based on TTM squeeze, the chart on CI is full on bearish and XLV is giving the same signals. So what I've mentioned in this, the reasons to take the trade is that it's based on TTM squeeze. So usually if I take any trade on TTM squeeze, my regular mean reversion indicators will not confirm that trade because it's based on completely different setup. So, the RSI, the DMI, all those things may not agree because it's purely taken on a TTM squeeze setup. But in this particular case, I've also mentioned that the although I'm taking it on TTM squeeze, the chart on CI is full on bearish. And XLV is giving the same signals too. So XLV is the healthcare sector. Obviously, you know my trading style. I do pay attention to the whole concept of a rising tide lifts all boats. So XLV is the tide, the healthcare entire sector, and CI is just a boat on that sector. So if XLV is looking bearish, then CI is most likely to follow that trend. Now, reasons to avoid the trade. So I have mentioned that Jobs report on Friday will move markets again. So, as you know, we are living in a inflation obsessed environment, and we keep getting these macroeconomic data releases every week. It can happen like anywhere from 1 to 4 times a week, and markets are like hyper focused on these data points. So last week was full of jobs report. There was ADP jobs report, there was unemployment numbers. So anytime we have that kind of data coming out, it doesn't matter how good your technical setup looks like, because that particular data on that day will change market direction. So you just have to always be careful about that. And that is the reason why for the last 2 years I've been trading at between 10 to 15% of my portfolio, because of the unpredictability in the markets due to the inflation obsessed environment we are living in. So, reasons to avoid the trade: jobs report on Friday will move markets again. So, it doesn't matter if this trade was looking good, it could just reverse the direction and go against you. Okay, so this is a chart of CI, which is Cigna again. And the setup looks like this. So at the bottom, I have this indicator called TTM Squeeze, which is a free indicator available on most of the platforms. They do sell a pro version of this, and I do have that version too, called TTM Squeeze Pro. I personally wouldn't recommend you spending any kind of money buying that indicator, because I don't think it adds any extra value to the free indicator. The indicator, and it's very expensive. The indicator costs like $700. So there you go. So the way the TTM squeeze indicator works is it's actually just another visual representation of Bollinger Bands and Keltner channels combined. And as you know, I've described in my book that I do use Bollinger Bands and Keltner channels all the time. So the way I use them is, if you look at the top part of the chart, the green line and the red line are the Bollinger Bands, the gray lines are the Keltner channels. And the way I use it is, when the Bollinger Bands are trapped inside the Keltner channels. So this is one incident where that has happened. And again, this is another incident. So when that happens, the stock is entering a low volatility period. And that means there will be, do not expect any kind of uh, reliable upside or downside movement until the stock is trapped in that consolidation phase. So this is a very bad setup for a swing trader, because for a swing trader you are trying to spot the tops and bottoms, and you are basically betting on the stock reversing and going in that other direction. Now with the when the Bollinger Bands are trapped inside the Keltner channels, the price movement is so little that you will keep getting chopped out. Your trade will not become profitable, and you can see that. So in this particular case, look at the price movement just chopping around and just going sideways. So that's how I use it. But the TTM squeeze indicator is actually very interesting. So what it does is, when a stock is entering that when the Bollinger Bands are entering Keltner channels, it will start plotting these red dots. And what that means is that, and if you just correlate that to the chart, the moment the red dot appears, the Bollinger Bands have entered the Keltner channel. So it's straightforward. So the way it works is, creator of this indicator, the way he uses it is that as long as the red dots keep showing up, you don't take any trade on the particular stock. You will take a trade when the red dots start becoming green, and you would take a trade based on the direction in which the squeeze is firing. So the problem with the reason why I don't take these trades is because once the stock goes into this sideways movement, you have no idea whether the stock will explode out of this consolidation phase to the upside or downside. So you don't know that. So taking any kind of directional bets is meaningless. Now, what this indicator attempts to do, I'll just use the word attempts because it does come with lots of false positives. And an example of that is a trade I took on Amazon on this indicator, and that actually went against me. So it does come with false positives. All indicators come with false positives. So what it does is once the red dots turn green, you have to pay attention to these bars and see which way the bars are firing. So if you see light blue bars, that means the squeeze is firing to the upside. So that means you need to take a bullish position in this particular stock. If the bars are firing to the downside, then you would take a bearish position. So that is what I did for this particular trade. Now let's go back to the day I took that trade. So this is the day. So the stock was trapped in a squeeze from almost a month now. Like so, from 6/11, June 11th until now, 3 weeks. Uh, Stock went into a squeeze, which is the red dots, and it's just chopping around in a very small trading range. Now at this point, we see the first green dot, and look at the bar. The bar is actually firing to the downside, the red bar. So you could wait for confirmation. So you could wait for, if you read about this indicator, it says that wait for at least 2 or 3 green dots and bars before you jump into a trade. So I actually took, so the trade I took was on the first green bar, because what I also saw was that RSI was dropping rapidly. Trend is bearish. So I took this trade on this day. Now let's switch back to today. And this particular trade is actually turning out pretty good. So if we just have 2 green dots and the bars are increasing in size. So the way this indicator works is, if once you start seeing the red bars fire, in this case, the stock is expected to continue going down until you see the first yellow bar. So like an example is here. So that is when this downtrend is over, and then you should either consider getting out of your bearish positions, or you could also take on a bullish position. Same thing on the upside too. So in this example, the bars start firing on the upside, the light blue bars, and then you can keep riding that trade until the first dark blue bar appears. That is when this upward movement is over, and you can see that the stock actually dropped after that. So that's this trade. Very interesting setup. Most people that use this setup are naked call buyers, because the my trade structure is a debit spread, so you can never make more than double your money on my trade. So people, somebody who's into buying naked calls could benefit from this trade when it plays out. So if you get into this trade at the right time and you keep riding that wave up or down, doesn't matter, naked call or naked puts, you could actually make a lot of money. So just throwing this out there, it's a very interesting setup. I would encourage all of you to try it out. Let me know how it works for you. While we're on this trade structure, let me switch over to SPY and look at what's happening with SPY. So as you know, the AI bubble is refusing to show any signs of slowing down, and SPY, QQQ are making new highs almost on a daily basis. So if I switch to a daily chart, 9 month, this is 9 month daily chart. Now ignore the TTM squeeze for now. So this is the phenomena we have seen since October. So look at this massive move up, slight pullback, I would say meaningless, and then markets are going up again. So this AI bubble is serious business. So markets are refusing to give up with no correction. So imagine this. I don't know. I can't even recall a time when markets went up for 9 months without any correction. So that's why I'm reluctant to go mainly bullish, and I've been waiting for a correction, and it never happens. So that's my mindset. You don't have to agree with my mindset, but that's my mindset, that this doesn't happen, but it's happening. So if you look at the chart on SPY, there are zero signs of slowing down or even a pullback right now. The markets are just going up literally on a daily basis. QQQ is even more pronounced than SPY. So QQQ is leading the charge, SPY is following it. Dow Jones entered a squeeze period here. As you can see, I didn't mention that on Discord. Dow Jones has been on a squeeze since 20th June. So there is little to no price movement. You can see it's just chopping sideways, up, down, up, down. There's meaningless. And at some point, it will explode out of this with a huge move. So the thing is that if QQQ and SPY keep going up, Dow Jones will eventually follow them and will again go back into a secular bull market. But there is a huge if. With earnings season starting next Friday, with JP Morgan, Citibank, Wells Fargo, all these big financial institutions reporting earnings. And in my opinion, those financial institutions will decide which way this squeeze fires. You will see the squeeze firing soon, and that when those red dots start turning into green, and you could take a trade based on that too. So if the banks report good earnings and the squeeze fires to the upside, I would suggest you wait for at least two green dots before you jump in, and you could ride that wave if you want. So that's Dow Jones, but SPY and QQQ, there's no squeeze. There's only one direction, and that's up. Now again, that where QQQ and SPY go next will also depend on earning season. So last earning season was pretty good, I would say, and that's why market just kept going up. So we have Netflix and Tesla reporting earnings the following week, not next week, following week after that. And then we have all the the big guys, the Mag 7, the Microsoft, Google, Amazon, all this earnings will start pouring in, and that will decide the fate of SPY and QQQ. One interesting thing I want to show you is if I switch back to SPY, but this time I will switch to a 5-year monthly chart. And the reason I'm doing that is because if you look at this chart, we are seeing a blue skies rally. This is called a blue skies rally when we have never hit these highs, so there is no resistance. So for a technical trader to figure out at what point will the markets pull back, it's very hard. You can use something called Fibonacci extensions for that, and I've been using that. But it's very hard because you don't have any frame of reference. So if we switch to a 5-year monthly chart, so this is not daily, not weekly, monthly chart, you will see something interesting. So this small chart actually shows you 5 years worth of price action on SPY. If you notice on August 2023, August 1st, SPY went into a squeeze, and then the squeeze fired in December. Now, since it's a monthly chart, it will be lagging. So, although the fierce bull market started in October, this indicator is actually catching up in December. So, in December, it's telling you time to go bullish. From December until now, the bars are just increasing in size, the light blue bars. So what would cause an end to this rally? You could actually watch SPY on a monthly chart and wait for these dark blue bars to appear, and that's when we will end up going into a sizable pullback or correction. Now, do know that this is a monthly chart, so if you only follow this and you don't follow the daily chart, you will miss out on that move because this chart will catch up much later than after the move has already happened. So you might miss one full month of negative price movement. Something to be aware of. Okay, let's look at the macroeconomic calendar next week. So, as usual, we have something coming out next week which is going to move the markets again. Last week it was jobs. Next week it's CPI and PPI again. It feels like we just saw CPI and PPI like just a couple of weeks ago. It feels like that to me, but here we are. We have CPI on Thursday, PPI on Friday. And you know what these to do to the markets. The markets are going to show a massive price movement between Thursday and Friday. So during these times, my recommendation, you know what my recommendation is, split your trading allocation two ways. Take maybe few trades on Monday or Tuesday and then save everything for Friday. By Friday, usually all the macroeconomic data for that week has been released and market reaction has already played out, so you can just trade in that direction. So that's my recommendation for next week. Again, CPI, PPI are huge market movers. So I'll do the same. I'll most likely skip trading on Monday, maybe nibble at couple of trades on between Tuesday and Wednesday, and then save everything for Friday. Quick look at earnings calendar. The main event for next week is the on Friday. So not only do we have PPI coming out, we have all these big bank reporting earnings on Friday, and that will set the mood for where Dow Jones goes next. Sometimes, depending on how bad the earnings or how good the earnings are, it can affect SPY and QQQ too. But most of the effect of the big banks is usually reflected in Dow Jones. So that's what we'll see next week. I'm not covering RRG charts in this video because seasonality, cyclicality, all of those things stop mattering, because the only thing that matters at that point is how the earnings come out. So in the next 1 month, I will bring in RRG charts every now and then, but pay attention to earnings, as that is the main driving force going forward. That's it for this week. Hope you enjoyed the trade alert that I covered, and I will continue doing that because got some positive feedback from our group, and I intend to continue doing that. I'll see you guys tomorrow.